Hi there. It's November 1st and the market is making a new high. The S&P, as I'm looking at it, is 3,061. That's breaking out of that range that we've basically been in for the last 3 months. And we've been at the sort of 3,000 level twice now, and we haven't been able to break out of that. That's happening today. So what's going on? So there's a lot of macro news. The big news this week obviously was the Fed. The Fed gave us the third rate cut of 25 basis points. If you think about the interest rate picture, a year ago, 10-year treasuries were at 3.1%, and today they're at 1.7. So if you think about the rate environment, it's a complete change from a year ago. So, last year we were worried about interest rates going up too much. We were worried about interest rates and inflation in the late cycle of the economic cycle. Forget all that. This is now feels more like mid-cycle. So the other part that we got that was a big surprise to most economists was the fact that the Fed has announced that it is expanding its balance sheet again. As you remember, there's this concept called quantitative easing, or what practitioners call QE. We did a lot of that basically to inflate asset values after the '08 crisis, and the Europeans are still doing that to prop up asset values that are on the balance sheets of banks. We were exiting that sort of environment. So it was a bit of a surprise that the Fed decided it would not let securities run off of its balance sheet, but they would replace them again, basically keeping a certain level of balance sheet activity from the Federal Reserve. This basically means, in a nutshell, that they are not only injecting liquidity by lowering rates, but also keeping a level of purchases of securities in the market. So all of this is good for asset values. So if you total up the monthly balance sheet expansion by the three major central banks, Federal Reserve, European Central Bank, and the BOJ, the Bank of Japan, you get about 95 billion of balance sheet expansion every month. This is huge. So if you look at easing across the globe, we are in a massive global easing cycle. So that's great for basically all asset values and appreciation. So why are central banks, why do they have the ability to ease so easily here? So basically it's because inflation is missing in action. If you look at all the inflation data, it's turning down. Expectations that were rising, and the reason the Fed was starting to raise rates last year, because expectations for inflation were rising. So if you look at most commodities, industrial commodities, if you look at gasoline and oil, they're all down year to date. So the fact that the inflation backdrop is very benign, it gives the central bank the confidence to say, okay, we're going to inject a lot more liquidity into the market and make sure that we don't hit a recession anytime soon. So that obviously is very good for equity markets, but also for bonds. So we are at full employment. When consumer sentiment is still at an all-time high, when markets make an all-time high, you get the wealth effect as well in the U.S. economy. So, we think it's full speed ahead in terms of sustainability of the current GDP growth, which is around 2%, at the low interest rates that we have, and the consumer being where it is. That actually puts us in a pretty decent macro environment going forward. So it's interesting, some economists compare this period a little bit more to 1995. If you remember that period, the mid-90s, sentiment was actually very bearish at that time. We were coming off the savings and loans crisis. The Fed had already lowered rates a lot during that period, but It was really in 1995 where the Fed put in a couple of more, actually 3 interest rate declines, just to make sure that we don't double dip or we don't hit a recession again. I mean, it's a little bit different, obviously, in the current context, where we've had this long and very shallow expansion over the last 10 years. But basically, the Fed is putting in a clear signal here that it won't tolerate us slipping back into a recession next year. So it's interesting if you look at sentiment regarding the market. We just got the big money poll, as they call it, which is the Barron's poll on the weekend. And it's very interesting. Only 27% of big money practitioners are bullish about the market. That's the lowest in 20 years. So, you know, we have bearish sentiment and we have pretty decent fundamentals. So that actually sets up a pretty good market. Couple other macro items. We had the GM strike that finally came to a close. You know, General Motors had its earnings out. They lost about $1 billion of revenue. That sounds like a lot of money, but if you put that in the context of $35 billion, which is about what their quarterly sales are, it's actually not a big amount of money. So what did the workers get? They got a 3% pay raise and a 4% basically bonus every 2 years. Temp workers got $32 versus $30 per hour. There was no change in the costs that the workers are carrying for the health plan. If you remember, the healthcare costs for auto workers are actually the lowest in any industry, so you know there was no change there. And the unions tried to get General Motors to move production from Mexico to a shuttered plant in Ohio. They didn't get that done. So if you think about the whole package, you know, $1 billion of losses to basically get certainty of about 3% out of wage inflation, if you want to call that, that's actually a pretty decent outcome for General Motors. We'll see that probably filtering into some of the other automakers. The UAW obviously controls workers, not just at General Motors, but all the others. So on other auto news, we got a very large merger. Fiat Chrysler is merging with Peugeot in Europe. That basically creates the third largest auto company in the world. Behind VW is number 1, Toyota is number 2. So it kind of shows you how difficult the auto sector is right now. So if you looked at just the recent release from VW, sales are down. Auto sales in China are slowing, and certainly the whole tariff war doesn't help the auto parts guys. If you think about supply chains, the automobile sector is the most complex supply chain in the world, where parts of cars are produced really all over the world. So if there's uncertainty about tariffs or tariffs going in, that just exacerbates the problems for the auto sector. So it's no fun these days to be an auto supplies manufacturer, and the sales, if you look at sales of autos, they've pretty much peaked everywhere, and seeing auto sales decline in China is not a good sign. So couple more international news, just Brexit. We got some more. The saga continues, the soap opera. We have an election coming up now in the UK in December. There's just more uncertainty there. It's really unclear to know how that's going to play out. That is weighing on bank stocks, certainly in Europe. And you know, it's unclear whether Boris Johnson can get a majority. There is some movement by some of the smaller parties in his direction to support the deal, but there is just great uncertainty there. On the tariff side, we were supposed to get a handshake or a deal in Chile, where the APAC meeting was supposed to be, but there is upheaval on the streets in Chile, so the Chilean president canceled the meeting, so we have to be patient here. and wait for the next stage of the tariff deal. The Trump administration is talking about a phase one. We get mixed signals out of China whether there's actually a phase one or not. Our view remains that the tariff situation, we will get some sort of a deal. This is certainly going to be Trump's legacy, and if Trump has any political future, it will certainly be on the economic front. So he will be very determined to get anything out of this which will be market positive. So on the micro side, on the company level side, we got lots of earnings in the last couple of weeks. In the general picture, the earnings were very, very solid. You know, the big ones were Microsoft, Facebook, and Starbucks. These are all core holdings for us. You know, Microsoft is just phenomenal. I mean, the growth there continues to be very, very strong in cloud computing. We've talked about cloud computing a lot. That's really cloud computing, or the public cloud, is sort of the first phase of what we call digital transformation. The next phase of this is really the hybrid cloud, or the private cloud. This is where you put basically applications and processes into the cloud that we typically use in our daily use. So this is a massive decade-long process. We're still early in this, and certainly if you're in that area, whether you're Google or Amazon in its AWS unit, and more recently we purchased IBM, for instance, because of its Red Hat acquisition. Red Hat is the market share leader in hybrid cloud, and that's a Linux-based cloud computing software that where they are very dominant. So IBM paid a lot of money for that company, Red Hat, $64 billion, and it's growing 20% plus. We believe that it was an expensive acquisition, but it was a good move on the side of IBM, and we're seeing that reflected in the growth numbers of all the cloud players. Microsoft, Satya Nadella, who runs Microsoft, mentioned that in the next stage of cloud computing, it's going to be very important that the dominant players basically work together, or and mention companies like Red Hat in that context. Starbucks was another highlight. Starbucks had a couple of years where their same-store sales was kind of on the low side. They announced massive same-store sales growth. In the US, it was 6%. There are almost no restaurants growing at 6% same-store sales. In China, they're growing at 6%. Starbucks just has a technology advantage over its competitors like no other. They were very early in investing in payment systems. I'm certainly a good example. When I hit the subway in the morning, I hit my iPhone and I have my iced coffee waiting for me. I pick it up, it takes 2 seconds, and it's booked right off of my Starbucks account. So that automation is just incredible. So I saw a statistic the other day. Basically, at peak load or peak activity for stores of Starbucks, they get 4,500 pre-orders at before peak by the time that store opens. So that's an extraordinary number. If you think about 4,500 coffees are pre-ordered from iPhones or your smartphone before the store is even gotten to peak, that's an extraordinary amount of activity. Starbucks is rolling out pickup-only stores now. They just did that here in New York as well. So that's kind of the trend in restaurants and certainly coffee chains. Facebook was the other standout. I mean, Facebook is in the news, it seems, every day in terms of the government trying to get after them. The idea of privacy and the idea of trying to regulate content within social media is obviously big hot button. But Facebook's earnings and revenues were incredibly strong. I mean, their revenues came in at 17.7 billion for the quarter. You know, they're growing at 20%. There are very few companies that are this large that have that kind of growth. The other two big ones, Alphabet, which is Google, and Amazon, also had very good revenue growth, but they were a little bit hurt by cost. Amazon has determined that it will be the leader in next day delivery. They basically have decided that it is their competitive advantage to be able to deliver products next day. They also found if you put items in their cart, in your cart, when you purchase items in Prime, Amazon Prime, if they aren't shipped next day, customers will tend to move those items back out of the cart. So for them, next day delivery is the holy grail, and most large players, whether it's Walmart or Target, are trying to emulate this. The only problem for the smaller players is it's very, very expensive. Amazon is so large that it has the scale that they can actually put a logistics network together. They're even leasing their own airplanes. And of course, the last mile is kind of the biggest challenge here. So one last thing on earnings. The Wall Street Journal had a great chart on the front page today, November 1st, and where they were showing where what sectors are really showing or meeting earnings expectations that are quite elevated at the moment. So, and it was interesting, the top three or top four are actually consumer staples, technology, healthcare, and financials. Those four, the fifth one is actually communications, which is the old technology, which is the old technology sector, which is now called communications, and that includes a lot of the social media companies like Facebook. So they're in the top five, so in terms of meeting or exceeding earnings expectations. On the bottom, and this will give you a sense, the ones that are missing earnings expectations are from the bottom are energy, real estate, utilities, materials, and industrials. Okay, so the expectations on the cyclical side of the economy have been very high, and the earnings estimates are coming down as companies are not meeting those expectations. And if you look at the more growth-related sectors that we tend to be investing in, are actually meeting or exceeding expectations. That to us is a great environment for, certainly for our investment style, to be investing in. So we can continue to feel quite good about that. So it's the marathon weekend here in New York. The sun is shining. It's a beautiful day outside, and I hope you have a good week. Take care.